Okay, I'm ready for you. Let's go. Now, what was our question? Your question here was, okay, just to inform everybody, I've got one of the students here who's asking some pretty good questions. So I just wanted to record it so that everybody else can hear what my answers are. Okay, so let's try and do everything on the screen. All right. Okay, so let's get rid of all of this. Question is why do we have a short trade in here? Okay, so there's a number of reasons why we don't have a short trade in here. Okay, let's have a look at what those reasons are. First reason is if we go to a daily on here, I have pointed out in previous videos, this is the Euro USD daily chart now. We've got a low in here. We've had this massive run on the US dollar, okay? And we can see that from our DXY, which I've mentioned in the last video. Okay, which I don't have here on this chart. Okay, so if you look at the DXY, we've gone into a pullback mode. Okay, now the trade, if we have a look at this candlestick formation in here, let's zoom right in. We have this candlestick formation in here. What do we call that? It's a bullish engulfing candle, right? And because of the volatility of that bullish engulfing candle, we can see that we may have a significant reversal. Okay, bullish engulfing, number one. Bullish engulfing tells us we may not want to keep going short. Okay, also we've had this massive run. Okay, we've gone from $1, what do we got? $1.24 all the way down to $1.15. Okay, let's have a look at where this has actually landed. All right. Almost, we can see over here in the corner, what's the price, the bottom price there? What's that say, Mark?
1.15
Okay, about $1.15. It's a fundamental level. It's a handle, right? What's a handle? A handle is like handles on a ladder, okay? Each cent or 100 pips is a handle, okay? So we've got the $1.15 handle sitting there. Okay, so it's gone and said, okay, $1.15 is now undervalued. We've got bullish engulfing back to the upside. Let's now go to our 4-hour chart. We've got a move all the way down, right? Aggressive move here, aggressive move here, long wick, and then bullish, very big bullish to the upside. Okay, so these two are almost, if we take out all of this riffraff in the middle, these two are almost like tweezers, aren't they? Okay, so then that's telling us that we're now going back to the upside. Let's have a look at the 1 hour. I'll zoom out a bit. Okay, so now we've got this huge doji wick in here. Okay, saying, well, there were sellers in there, but then everybody pulled the pin and didn't want to sell anymore. So that's in the 1 hour, it went down and back up. Okay. So buyers are stepping back in. So we've not only got that big wick there, we've also got triple bottom almost. So bottom, and the wick. So that's telling me reversal. It's not telling me to keep going short, is it? No. Even up here, it's not telling me to keep going short. If you were going short up here, which there is actually no evidence to tell us to go short up here, right, we would be looking at only just a small move, not a big move. All right. Now, and this is a trade that I took. All right. This was Friday. I had my limit order sitting right just in front of the 50%, in between the 100 period moving average and the 50%. Okay. This came down, picked me up, and we're going for it. So now where's my target? Okay, target is, I started off with my stop loss down here. Whoops, let me use this here as my stop loss. So I use my stop loss here. Let me even just write it on the chart here, guys. Okay, SL, initial. There's my initial stop loss. Make it nice and neat. Here's my entry. Here. ENTRY, entry. My target is, let me just do this so it really sinks right in. This is point A. Our next one is point B. Our next point is point C. Now, let's have a discussion about where point C is. Point C. Point C is not the 618. It is not the entry. It is not the 50%. It is not the 100 period moving average. It is the low. Okay. There's my C point. Okay. And what are we looking for our target? AB equals CD. Okay. So let's copy this. Double click on the line, hold down my control key, and move it across. Here is point D. Point D. There's point D. Now where do I put my target? Here's my target. So let's decide on where we're going to put it. Where should we put it? Should we put it just above point D? Should we put it on point D? Should we put it just in front of point D? Perfect. So there's my target up here. Okay? TP. And what do we do with our target? Once we enter the trade, what do we do with our target? Nothing. Zero. Okay? What do we do with our stop loss? Move it. Right? So there's our initial stop. Our next stop, once we've got confirmation that we've got movement in our direction, we move stop 2. SL1, I'll call it. SL1. Okay? There's SL1. Okay? So now we've moved from, and this is the whole theory of trading. Now if you guys can do this, you'll be traders. We've got our entry, our entry is here, and let's take a measurement to our initial stop, which is 113 pips. We'll take a measurement to our target, which is 182 pips. What's that as a ratio? Hang on, let me just work it out, guys. See if you can work it out before I can get my calculator up. What was it? 113? Oops. 113, 182 equals, hang on, hold on. Was it 183? 113. It's 1.61, or 1 is to 1.61. Okay, which usually if you do it the way that I've done it, 50%, just inside the 50%, 2D, it will always work out to be approximately 1 is to 1.5. Okay? Let me make that bigger for everybody. Okay? That's to point D. From point A, entry at about the 50% to point D, or you take profit, is around about 1 is to 1.5. Every single time you do it. Okay? So this happens, what did I say before? This should happen seldom. I was going to say seldomly, but seldomly is not a word, is it? Okay, that happens seldom. Okay? Now, when we move our to SL1, which happens more often, should happen more often, okay, if you're following the rules of 2 or more support or resistance areas, right? If we've got our entry now, let's measure it. Measure entry to stop 1 is 16 pips versus 182 pip, 183. Let's work that out. 16 divided by 183 equals, no, it's 183 divided by 16 equals 11. 1 is to 11. Now this one will change more often, okay? 1 is to 11. What a great risk to reward ratio, right? Okay. More OFTEN, more often, okay? This will happen more often, and this will happen seldom, okay? Now, that is the whole theory of trading right there. I can't make it any more simple than that, right? Because now, if you've got your stop loss so close to your entry at 1 is to 11, you can get knocked out 11 times and get one winner, and you've broken even, right? Okay. So even if you make a mistake, as long as you follow this rule here, you should be fine. Okay. Now it doesn't always happen at 111. What I usually like to say, it usually turns into 1 is to 5. Okay. All right. So, but the idea is, and trust me guys, I make the mistake even now, right? It's hard to do because you're a human being, okay? We've got confirmation bias, we've got cognitive biases which disturb us all the time. But you've got to be so disciplined in doing that, okay? If you are disciplined at doing that, because I've got a trader I'm just about to give $500,000 to $1 million to, who can actually do this. He's actually better than me, right? Because he's followed my instructions to a T, okay? So, if we can do that, then we're going to be good traders, okay? Okay, so make sure the rules are simple, right? 2 or more areas of support and resistance. Make sure that you identify what's happening in front of you. Don't try and create something that happens in front of you, all right? The confirmation bias thing that I've been crapping on about, okay? Make sure that you pick up on all of the signals, right? Do we have a reversal pattern that is in our midst? Even if you get it wrong, right? If you follow the rules that I've put out here with your risk to reward ratio, right, you should still at least break even, okay? All right. Okay, resume, okay. All right, another thing that I need to point out, okay, is if you've got your chart zoomed to this extent, right, you've zoomed in too far. Just come out one more, knock it out one more go, okay? What we want to do is we want to try and see on a 1 hour chart what the guys on the 4 and the daily are doing, okay? Because the banks, the instos, the wholesale guys, the guys with millions that can push the market are the guys that trade on wider time frames, okay? And what we want to do is we want to get our entry right on the 1 hour chart, right? But we want to have a look at what's happening on the bigger charts, okay? Unless you're doing the news release one that I've got on my news release strategy that's on a 5-minute chart, okay? But like I said, we need to draw our trend lines. We need to understand what's going on the big time frames. See, like here, this candle up in here on the daily, we've come up and we've had a look underneath this 200 period moving average. Okay, so that was a resistance area to continue. Okay, so zoom out a little bit. So let's just knock it out one more go. Okay, so you just can't see the candles. You might want to zoom in so you can see the candles, but always zoom out to see what's going on, to identify that, hey, we've had a whole move down here, we've had a whole move back up there, so really it's not going to move all the way back down again, is it? Unless there's fundamentally something wrong with the economy, right? So we need to get in a little bit. So what we want to do is we want to, if it's not obvious to everybody, every other single trader on the planet, then it's not going to be obvious, and price isn't going to do what you want it to do, right? Price only moves because of the herd, right? So you've got to think like the herd, right? See what the other people are seeing, right? Everyone can see this big pin bar in here. Right, everyone could see that. In saying that, that was a low liquidity at the end of Friday trading. That's the reason why that happened. Right, but let's go across to the Aussie. Right, let's have a look at the Aussie. Let me turn it to. This was a brilliant trade in here. Move, 50%, huge move to the upside. Right, we had a continuation of this huge move because there was good news in Australia as well. We have got a strong economy, grew by 1%, which changed our GDP, right? So this is why we've had such a bullish move up in here. And that would have been, even if you came in late, that would have been a good one to keep going on the next day. Pin bar here, pin bar, big move, 100 period moving average. You may have just missed it. Well, bad luck, right? Because everybody else saw it, they wanted to get in early, right? So just bad luck on that, right? So you'd still be in it to the upside. One thing is as well, I've noticed this from a couple of my traders. Actually, let me go to another one that I want to point out. Let's have a look at the Swiss. Swiss was a nice short trade in here. Let's go over to the 1 hour chart on the Swiss. I'll zoom out. Let's go to 4 hour. Okay, so one of my traders has taken a short in here because obviously we've gone and we've broken this low, so that's becoming significant. That pin bar is now irrelevant because we've now broken its low. Okay? It's also irrelevant because it didn't continue. Okay? However, we've got a fantastic 50% plus a cross of the 250 and the 200 period moving average on the 4 hour chart. Great entry in here. Okay? So your entry would have been just in front, in here. Okay? Now, what this trader did was, here it is, it's actually here. There it is, down there. Okay? So what I'm trying to say is if you have not entered at that exact right point and you're trying to chase the trade down here, then wrong. Okay? Error. Okay? Because now your risk to reward ratio isn't what I've just spoken about. Does that make sense? Don't chase the trade. Put your limit order in. If it works, it works. If it doesn't, don't chase it. Okay? Because you've gone and stuffed up all of your risk to reward ratios. Does that make sense? Okay. And don't worry, it'll happen again. I can guarantee you, I've been doing this for 15 years. It will happen again. All right? Don't get into the FOMO, fear of missing out, and chase trades. That's an error. Okay? All right, good. Let's just pause that here. Resume. All right, guys, here's another error that I've just picked up with my student that's sitting here with me. Okay? He has drawn a trend line down here. Okay? Seems legitimate, right? But it's actually incorrect. Okay? This trend line in here should actually be from back here. Your trend line is back up here. me do the ray. Ray. There we go. There's your trend line there. Okay, if you're wanting to do another trend line, it would really be from here. There's your other trend line. Okay. The trend line, let me change the colour. This trend line from here across here is not correct. Okay, it seems correct. You could convince yourself that it's correct, but I'm not a fan of it. Let me just make it grey. Okay, I'm not a fan of that. Okay.
So why are you?
Because this has already moved. The town trend's already happened. We're really trying to look for the tops up here. Okay, not something that's halfway through. Okay, trying to find the beginning of the trend, or the beginning point of your drawing your trend line halfway through the actual trend is really not going to work. What it should be is, if you're wanting to do this, is do a channel. There's your channel, right? Okay, but this is like very aggressive down to the downside, so I just leave it. What we really want to see is, have we broken here? Here's your entry in here. If you're wanting to do an entry like two or more, it doesn't have to be Fibonacci. It can be this 50 period moving average and the trend line. There's your entry here. All right, your stop will be just underneath these last lows, or you can start your stop down here. Okay, so here's your entry somewhere here. Let me get rid of the ray. Come on. So two or more does not necessarily have to be 50%. There's your entry, right? Here's your AB equals CD. If you're aggressive, you do AB equals CD here. Right, you're looking up here. Somebody else, one of my other traders has already picked up. That might be the D point for a reversal. Okay, you'll find that this D point will also coincide with a Fibonacci level being 786 or the 882. Let me just. Add 786. Let's see whether I'm right or wrong. 0.786. 78.6. See whether I'm right. Okay. You guys, did everyone see that? Hopefully everyone saw that the 786. Like these levels, you know, they're not there for no reason, right? It all fits together. Right? It's like a jigsaw puzzle, right? So that's a good reversal area, and one of the traders has put a reversal in there, okay, for a continuation, right? Or just for a little bit even, right? Okay. So yeah, I would not put my trend line across that. It just doesn't make sense to me, okay? These are my two trend lines if I'm going to do any, okay? All right. Let me just pause it there. Okay, here's another thing. Psychologically, right? Okay, first thing with my student here, I've just had a quick discussion with him, and I've identified that probably his main problem is that he can't identify the reversal patterns or the reversals. Okay, so what I want everybody to do is brush up on what reversals exist in the market, technically, right? One, divergence. Okay, is divergence present? If divergence present, then we may have a reversal. It's just a filter. It's not an excuse to trade. It's a filter to stop trading in that direction. Okay, because there may be a reversal. Number two, double tops, double bottoms is a reversal. You don't necessarily have to trade it. Some people do trade it. Some people don't. You've got to decide whether you want to trade it or not. But that's a reversal pattern. Head and shoulders is a reversal pattern, okay? And again, pin bars or candles with big wicks and engulfing patterns or tweezers, okay, are reversals, okay. Now, you've got to, obviously the volatility of those pin bars and engulfing and tweezers, etc., must be relative to the volatility that's going on at the time. Volatility meaning the ATR, the average true range, right? So, just hold on. Okay, so another problem is that everybody looks at the market as though it's like you can make money out of it without doing anything, okay? It's like going fishing, right? You got to like identifying all the reversal patterns, doing the setup, all that sort of stuff is like setting up the rig of your fishing rod, putting the bait on it, okay? But you can't catch a fish if the fish ain't there, right? You've got to your job to find the fish is to find the patterns that are going to confirm the reason why you should be getting in. And you should only go for the big fish, right? The high probability stuff, right? If it's not there, just don't trade, right? That trade I've shown you that I did before, that's my first and only trade for the month. I've done nothing else, okay? Right? If you don't need to trade every single day, right? Only trade the high probability stuff. So don't beat yourself up as well, okay? Because the thing is, this level, and what I'm trying to tell you is my 15 years of errors, okay? I've been there, I've done it, right? So don't beat yourself up. It comes with experience, but you'll get there, right? Just listen to what I'm saying to you and try and absorb it, right? If you don't get it, call me and I will help you. I'll step through it with you and I'll go over and over it again until it sinks in. Okay. I'm going to leave this video here. Okay, guys, thank you very much for listening, and if you've got questions, let me know.